Okay, so if you're a small business owner and your LLC is really starting to take off, there's this incredible tax strategy that can literally save you thousands of dollars. But, and this is a big but, it comes with some serious strings attached. So let's dive right in and unpack what this whole S Corp election thing is all about.
You know, it's that classic good problem to have, right? Your business is finally doing great, the profits are rolling in, and then you get your tax bill. And oof, you suddenly realize that every single dollar of that hard-earned success is getting absolutely hammered by taxes. It's a huge pain point, and if you're feeling it, you are definitely not alone.
And here's the number that's causing all the pain, 15.3%. See, with a standard LLC, every single dollar of profit you make gets hit with that full 15.3% self-employment tax. Now, that's for Social Security and Medicare, and it's on top of your regular income tax. So as your business grows, that percentage, well, it really starts to add up.
So what can you do about it? Well, for a lot of businesses, the answer is electing S Corp status. And I gotta stress this next part because it's super important. You are not creating a new company. Your LLC is still your LLC from a legal standpoint. This is just you telling the IRS, hey, from now on, I want you to tax me differently. It's a strategic tax move. That's all it is.
And here is where the magic happens. Think about it like this. With a regular LLC, you've got one big bucket of profit, and the whole thing gets taxed. But with an S Corp, you get to split that money into two buckets. The first bucket is your salary. You pay yourself a formal wage, and yeah, that gets hit with payroll taxes. But the second bucket, that's your distribution, basically the rest of the profit. And here's the game changer. That distribution bucket is not subject to self-employment tax. That is the whole point.
Okay, let's make this real with some numbers. Let's say your business made $120,000 in profit. As a standard LLC, boom, you're paying self-employment tax on that entire amount. We're talking over 18 grand. Now, let's look at the S Corp way. You decide to pay yourself a reasonable salary of $60,000. You only pay the tax on that 60 grand. The other $60,000, that comes to you as a distribution totally free from self-employment tax. The savings in your pocket? About $9,000 for the year. That's huge.
Okay, I know what you're thinking. 9 grand in savings sounds incredible, right? And it is. But here's the catch. This isn't just some magic button you press. Choosing to be an S Corp brings a whole new level of complexity and, frankly, responsibility that you have to be prepared to handle. And this brings us to the absolute #1 rule, the thing the IRS looks at with a magnifying glass. You must pay yourself a reasonable salary. This is not a suggestion, it's not a guideline, it is a hard and fast rule, and trust me, the IRS is watching.
Yeah, and the IRS doesn't mess around here. They've basically said, look, if you're an owner who's actually working in your business, you're an employee, period. So, trying to game the system by paying yourself a ridiculously low salary, like say 10 grand a year, while taking out huge distributions, that's basically painting a giant red target on your back for audit. Don't do it.
So the big question is, what the heck does reasonable even mean? And well, it's not a simple number. There's no magic formula. The IRS looks at everything. What do you actually do in the business? What's your experience level? How many hours are you putting in? And the big one, what would a company have to pay someone else to do your job? You have to be able to look at your salary and justify it, to prove it's legit. Now, you've probably heard people talk about a 60-40 rule or some other easy split. Let me be really clear about this. That is a complete myth. It does not exist. The IRS has never ever said that any fixed ratio is okay. Trying to use a simple rule like that is just asking for trouble, and it's a super risky way to approach this.
Okay, so besides figuring out your salary, there's the whole other side of this coin, the day-to-day stuff. Going S Corp isn't just a tax thing, it fundamentally changes how you run your business. Get ready for more paperwork and a lot more process. Here's the biggest mental shift you have to make. You're not just the owner anymore. You are now officially an employee of your own company. And what do employees get? A regular paycheck through a formal payroll system. The days of just transferring cash from your business account to your personal account whenever you want, those are over. This part is completely non-negotiable.
And running payroll sounds simple, but it's a whole beast. You got to do it on a regular schedule. You have to withhold all the right federal and state taxes. You have to send that money to the IRS on time. You've got to file quarterly forms like Form 941, and at the end of the year, you have to issue yourself a W-2 just like any other employee. Honestly, this is why most people in this situation just hire a payroll service. It's a lot.
All right, we've talked about the awesome savings, but we've also talked about all the new rules and paperwork. So the million-dollar question is this actually the right move for you and your business? Let's break down how to decide.
So there's a pretty solid rule of thumb that most accountants will give you. This whole S Corp thing really only starts to make financial sense once your business is consistently making somewhere in the ballpark of $50,000 to $80,000 in profit a year. If you're making less than that, the cost of running payroll and the extra accounting fees will probably just cancel out any tax savings you might get.
It really comes down to some simple math. On one side of the scale, you've got your potential tax savings. That's the big prize. But on the other side, you have to pile in the new costs. You're going to have fees for a payroll service, and your accountant's probably going to charge you more too. You just have to be honest with yourself. Is that pile of savings going to be way bigger than the new pile of costs?
But, at the end of the day, this isn't just about the numbers on a spreadsheet. It's really a question about business maturity. Choosing S Corp status is like saying, okay, we're ready for more structure, more rules, more formality. So the last question you should ask yourself isn't just, can I save some cash? It's, is my business truly ready to grow up and operate at this next level? It's a huge step for sure, and definitely one you want to think through.